So as expected, the Federal Reserve has cut interest rates. The expectation leading up to the meeting was 0.25%, but just the day before, they swapped to 0.5%, which ended up being the result of the Fed meeting. Now, what does this mean for you, the economy, and mortgage rates? Here is our take on the news. To start, we're sticking to our guns, and we're making the bold statement that this does signal the Fed is behind the curve. We believe the reason they decided to go with such a big cut is because they don't want to risk falling behind and seeing unemployment continue to rise, as well as the economy continue to weaken. We have to remember, it took almost 2 years for these rate hikes to fully trickle into the economy and really start to slow things down like they intended. With that said, we feel like we still haven't felt the full effect of these rate hikes, meaning the Fed may be in a position where the cadence of these rate cuts end up becoming the norm, even though they stated it wasn't in the Fed meeting in September. The thing is, we believe they won't have a choice to continue to cut at this pace if we continue to see unemployment rise, or worst case, we start to see deflation. Now, how does this correlate to housing and mortgage rates? Well, let's first remember mortgage rates are controlled by the mortgage-backed security market, which are publicly traded like stocks. So we've already seen major improvements in mortgage rates from the anticipation of the Fed meeting and the interest rate cut itself. Frankly, the mortgage market doesn't really know how to react from the actual meeting in September, since mortgage rates aren't directly linked to the Fed rate. What they're more concerned about is future inflation and job reports before they decide which direction they're going to continue to head. We believe the ripple effect from these interest rate hikes will continue to bring inflation down and increase the unemployment rate. If we're right, we'll continue to see mortgage rates fall. And if the economy continues to worsen at a rapid pace, we're going to see mortgage rates fall at a rapid pace. But we don't think it's going to be a straight line down, and we think we're going to continue to see volatility over the next several months. Overall, this news from the Fed will bring asset prices like real estate back up again, simply because borrowing costs are going to start becoming cheaper and cheaper. So here's the thing. If it's been 2 years and you're still on the fence, now is really the time you should start acting before it's too late.